JessicaCech. I'm a real estate agent, and I am here with Brent Green. He is a loan officer and one of the great lending partners that I work with from Lake Michigan Credit Union, and we are going to talk about the market. I thought that we could start with a scenario because we both have offices in Blanc Township. So I looked up what the average sales price for a home in Blanc was in the month of July,
Sure.
which was $275,000. And I thought what might be fun, since you're a loan officer, and this is always fun, is to go through 4 different scenarios of what a monthly payment might look like.
So with the conventional loans, you can do as little as 3% down. In this instance, I've got a 5% down example. With a purchase price of about $275, it's a mortgage at $261, $250. That payment with taxes, estimated insurance, and PMI is about $19.85 a month.
And what about if you did, so adjustable rate mortgages, which we're going to talk about in a minute some more.
Sure.
But if you started with a 7-year, because there's different years, let's look at a 7-year
Right.
ARM, also with 5% down.
Right. So an adjustable rate mortgage typically will have a fixed rate period. That 7-year period is, in this case, this is called a 7-1 ARM, and it's fixed for the first 7 years. After that, it can adjust up or down. Over the life of its loan, it does that once per year. The loan can always be refinanced. It's not got a prepayment penalty or anything like that, so it's possible to refinance them. In general, that's going to save you quite a bit per month. That payment's about $18.07, so $180 a month cheaper.
Now, why is that? Is it because a 7-year ARM is at a lower interest rate right now?
Correct.
Okay.
So your 30-year fixed is mid to low 5s.
Mid to low 5s, okay.
Your 7-1 ARM is your low 4s
Oh, wow.
to high 3s. It depends.
Okay.
So that savings of at least 1% to 1.25% on the interest rate makes a big difference in the payment.
Yeah, wow. Okay, great. Okay, and now let's change to a different type of loan. Let's look at an FHA loan.
Sure.
With the minimum amount down.
Right. So an FHA loan requires 3.5% down. Its payment total estimated here is about $2,083. It's a little more expensive than the 30-year fixed conventional, and that reason solely relies on the mortgage insurance premium. It's more than double on an FHA loan. It's just more expensive.
Really? Is that true for all FHAs?
Yep.
Okay.
Yep.
Okay. So double the PMI. Okay. And now there's another program that you could combine with an FHA that helps with down payment assistance.
Right. So yeah, MSHDA down payment assistance programs, or MSHDA DPA. That combines with an FHA loan, so it's 3.5% down. They will give you a loan, what's called a soft second, for $7,500 to go towards your closing costs and down payment. The minimum you have to come out of pocket with is $1,000 or 1%. It's got all the same features of an FHA loan. Its interest rate is considerably higher. It is on the upper 5s.
Oh, okay.
But this is all associated with the fact that they've got this down payment assistance that you don't have to pay back.
Okay, so that's did you say it's 7,000?
7,500, yeah.
Okay, so that 7,500 is like a gift from the state of Michigan?
Yeah, it's a soft second, meaning that there's no payment and it's forgivable over time. So if you keep the home for a long period of time, that eventually goes away.
Oh, wow. Is there an income cap on that with the MSHDA?
Yes, MSHDA has income caps. It has sales price caps. You're really looking at $225 or less.
Okay,
on a
for a
sales
purchase price.
Yeah.
So all of these were with good credit scores.
Mm-hmm.
And so as your credit score changes, and we've talked about this
Things
before.
become more expensive,
Okay.
right? So what happens when a credit score is 740 or more, that's really the best when you're talking a conventional loan. Let's say your credit score is 650, which is pretty common. It's not an uncommon credit score. On a conventional loan, that causes that interest rate to go up dramatically.
Wow.
It also causes the mortgage insurance to go up. And this is where FHA becomes a better product. It becomes cheaper.
Okay, that's interesting.
Because FHA doesn't pay as much attention to the credit score and its pricing.
Oh, wow. Let's explore more about whether an FHA program or product versus a conventional product? Like, what do you look at to determine if a borrower is going to better fit? You said the credit score?
The credit score is the primary driver. FHA is much more lenient with that than conventional when it comes to pricing.
Okay, what about how much cash you have as a borrower in
That too.
Okay.
That too. Both have, you can do a gift from a relative with both a conventional loan and an FHA loan.
Okay.
But FHA is typically able to be less out of pocket than a conventional loan,
Okay.
Especially for those mid 600 credit scores.
Okay, that sounds great. Let's take the down payment. That's not the only cash you need when you get to the closing table.
Correct.
Okay, so let's say that you were a conventional borrower and you were purchasing this $275,000 house and you were bringing 5% with you. What do you ballpark it out for us? What's that going to look like cash to close in Grand Blanc Township?
Cash to close, you've got a couple different components. You have your down payment plus your closing costs. Those are the fees to get the loan and to close at the title company. And then you have your prepaids, which are your taxes and your insurance and an interest adjustment. Ballpark on this is about $3,000 in closing fees. That includes if an appraisal is required, it includes the appraisal, all your underwriting processing fees with the lender. It includes your title company closing fees, and it includes your recording fees, and then you've got any real estate related costs, administrative costs that go with the real estate.
Okay, so we've got $3,000, and then we have the prepaids on top of that.
Correct. So prepaids, it's 1 year of insurance.
Homeowners.
Yep, 1 year of homeowners insurance, a full year of taxes between prorations and escrows.
Gotcha.
And then you've got the interest adjustment. If we looked at what we expect taxes and insurance to be here, it's about $450 a month between the two of them is a ballpark figure. 12 months on that is going to be what? 48 plus another 5,400.
Okay, so that's the prepaid portion?
Yeah.
Okay, so we've got $3,000 in closing costs, $5,400 about in prepaids, and so that puts us at $8,400, and that is now added to the 5%.
The 5% down, $13,750.
$13,750. Okay.
For the down payment.
For the down payment.
Plus the tax, plus the closing costs and the prepaids.
So it's $8,400. So what is $13,750 plus $8,400?
$22,150.
$22,150. Okay, so when we're talking about, I think this is really important to know that it's the down payment, but you also have to have other cash.
Correct.
And so if you don't have that much cash, what are your options?
Lending is problem solving, right? So we always look for, well, what other options do they have? Do they have a 401k that they can borrow against? Do they have a gift from a relative? Do they qualify for MSHDA? That's another down payment assistance product. There's time that it takes to find the house, and then we've got a certain amount of time to close. So they do have a few months.
So they can gather some more resources.
Yep.
Let's kind of transition here and talk about adjustable rate mortgages, because I've been out and talking with borrowers who are savvy homeowners. They've purchased homes before they remember what happened in 2008.
Right.
And I say the word, have you considered maybe an ARM? And their panic comes in their eyes. Is there a difference between what was happening then and now?
Oh yeah,
Okay.
a total difference. In 2008, the underwriting standards were very different. It was mostly credit score based. It was not necessarily based on their qualifying income.
Okay.
A lot of times you could do no income verification loans. And they also had what they called an option arm. An option arm, the option being you could determine how much you want to make as a payment. They give you different payment options. And some of those options don't cover the amortization. They're negative amortization. So in other words, you're adding to your balance every month a portion of the interest because you're not paying all of it.
Wow.
So option arms were really, those are a thing of the past. The arms that we have now were available back then, but they're an amortizing loan. They aren't interest only. They do amortize positively, so your balance goes down every month.
And that means you're paying off principal.
You're paying off that principal. Candidates tend to be here people who are upwardly mobile, where they're going to make a change within the next 7 years to 10 years. Most mortgages don't actually even stay out standing for more than 7 to 10 years. That's the average life cycle of a mortgage.
Because people move and
You move, you sell, you go, you get a promotion to go somewhere else, you take another job in another city, it's part of the gig. So that's where this 7-1 arm really is a sweet spot.
Let's talk about what a potential home seller can do when they want to sell their home, but they also need to buy simultaneously. What can those people look at doing? Do they have to always sell first and then buy, or is there something else they can do?
No, there's for qualifying buyers, ones that have sufficient income to qualify, they can carry both house payments and do what's called a bridge loan. Bridge loan will bridge the gap between when they sell and have that equity available. It gives them the equity ahead of time. It's essentially a home equity line of credit.
Okay.
They can pull that money to do a down payment on the new house so long as they qualify with all the debt.
So the benefit of someone doing a bridge loan is that they can take as much time as they want to find the perfect new home without needing to sell their old home first.
Right, and we would determine that at the pre-approval if
Okay.
they qualified to do something like that.
Okay, and then what are the risks of that?
Well, you may, these loans tend to be shorter term. So your bridge loan is a 12-month term. We will extend it if necessary, but that gives you the time that you need to sell.
But you'd be paying mortgage on both?
Yes.
Okay, so you could potentially have a whole year to do it, but you have to be prepared to pay two
You're
mortgages.
paying 2 mortgages, yeah. A bridge loan tends to be your step-up buyer
Uh-huh.
rather than your first-time home buyer.
Sure.
So it's just a different animal and a different set of qualifying circumstances. They tend to have more equity. They tend to have more in reserves. They tend to have higher paying jobs. So it becomes more common.
Okay. So they've paid down their house, so they have higher equity ready to go. They also have more money in the bank or more money in their 401ks.
Yeah.
So they've got that kind of thing going, and
Yeah.
their jobs typically pay better.
They're that second stage, third stage of life, right?
Okay,
Where they've got this isn't their first home.
Uh-huh.
This is their second, third, or fourth.
Gotcha. Okay, it sounds like a pretty great loan if you can
It
get
is,
one.
yeah, it is. It's convenient. It does help. We don't allow people to be overextended. We do have limits to how much debt we'll allow them to have. So
Okay.
we watch that pretty carefully when we're doing a bridge loan.
So you're looking at like the debt to income and that ratio.
Correct.
Okay, so what is that ratio?
Typically, you want that to be at 45 or less, 45% of their gross monthly income.
So if they were making $5,000,
Well, 10 grand,
10 grand, great.
round number. 10 grand, they could afford $4,500 worth of debt.
Okay, and that includes,
20 grand, now we're talking $9,000 worth of debt.
okay,
That's a lot.
yeah, 20 grand a month.
Well,
Or-
not only in the income,
Uh-huh.
that's somebody who's making $240 a year,
Uh-huh.
but it's a lot in the sense of spending $9,000 a month would be a considerable amount of debt.
Yeah, okay, and that's looking at the house payment, the car payment, the boat payment, the second house, or whatever?
Yep.
Okay, all those things.
All those things, not utilities, not insurance or anything like that, but just your credit payments.
Okay, 45%. So let's take a look at what's happening with interest rates, because that seems to be on the news cycle every single day.
Right.
And there's a lot of talk about Fed rate hikes and what that means. So can you talk to us about that and how it relates to mortgage rates, or doesn't relate to mortgage rates?
It does both, right?
Uh-huh.
So what the federal funds rate is, it's a short-term overnight rate between banks. And the Federal Reserve sets that interest rate that banks pay each other overnight. So they were at 0 to a quarter.
Wait, what? They pay overnight?
Mhm.
Can you, what does that mean?
Well, it's just that. What is the interest rate that a bank pays for the money that they borrow?
Overnight?
Mhm.
One day at a time?
Yep.
Okay,
Yep, overnight.
okay,
So that rate is very short-term, right?
yeah,
It's
Overnight?
it's not 1 year, it's not 2 years,
Right.
it's 1 day.
okay,
So when you talk about, they started out the year at 0 to a quarter percent on the federal funds rate. Their first rate raise was a quarter point, so it went from 0 to a quarter to a half, and then they did another half, so they got up to a 3/4 target rate. Then they did a 3/4 hit. So and then it went up to 1.5. Now they did it again, another 3/4 point bump. So now it's at 2.25.
Wow.
Yeah, all in less than 6 months. Really.
Mm-hmm.
That has a significant impact of slowing demand, which is what they're trying to do, is trying to alleviate inflation from the demand side.
So in another way, is it saying that they're making it more expensive to borrow money?
They're making it more expensive to borrow money, which makes it people borrow less, and then demand wanes because they have less capital to work with.
Okay, and why is making demand go down better?
Well, it's not necessarily better. It's what's its end game. What it's after is reducing inflation.
Okay.
If we can reduce inflation, then things become more affordable going forward. They aren't going up 10% every year. You know, that gets to be a bit taxing on people's monthly income. So you want to make sure that what the Fed is trying to do is ease that demand to create a balance again in the supply demand.
So are they trying to balance out how much, how expensive it is to borrow on like big ticket items, like
Everything.
all the things?
Everything.
Okay.
From your home equity line of credit gets impacted by it, because these are loans that are based on prime, and prime goes up every time the Fed makes a move. It impacts your car loans. It impacts, which is a big loan. It can impact your credit card, which may not be a big loan.
Mm-hmm.
So it really has a influence throughout the entire economy. When you talk about mortgage rates, now is it direct? No, not at all. For example, they moved a 1/4 point and the mortgages doubled within a month.
Higher?
Yeah.
Okay.
They went from in the 3s to almost 6.
I remember that period. I didn't work very much during that period.
Well, that's a real shock to the market. It's a
Yeah.
shock to the system. It takes buyers out of the game,
Yeah.
right? Because they can't afford it anymore. What they were looking to do is just come out of reach.
Yeah.
Now, that's from bumping a little bit, just a 1/4. That whole thing is more about market expectations. The market did not think that was sufficient,
Okay.
and that would not fight inflation. And what does the one thing that long-term bonds and long-term money, mortgages are 30 years, treasuries 10 years, 30 years. Long-term money hates inflation because it erodes the value.
Okay.
So they react really poorly to when there's inflation. Now, when we get inflation under control, they react positively. So what you saw was a 1/4 point bump the market perceived as inadequate.
Okay.
That 3/4 point bump, the most recent one, the market saw as fantastic. You're gonna get to neutral, or less accommodative policy. You're gonna get to a point where you've got inflation under control. With that, the rates actually came down in this last 2 weeks.
That's so fascinating. Okay, so just to put it into my own words, the Fed started off with a small rate hike.
Yeah.
And the markets thought that was insufficient, and so the mortgage rates doubled.
It went crazy.
Okay.
Yeah, it went up considerably.
Okay, so that's not correlated at all. And now this latest one, the latest hike, what was it, like a week ago, 2 weeks ago?
Mm-hmm.
Okay, and that was
Yep.
a 3/4 point on top of everything else.
Right.
And then the mortgage people relaxed.
What would be considered a market rally.
Okay.
And rates came down.
Okay.
More demand for mortgages.
Yeah.
It's all about inflation.
Wow. Yeah.
So has a major impact. So the Fed can do the same thing over and over again, and it can have a different impact.
Raise.
Yeah,
Okay.
just depends on what the market's expecting, and where we are with the data. They keep showing current inflation data is not good, right? We're up 8%, 9% year over year. The market feels right now that future inflation prospects have been quelled. That's going to be good. We're not going to have it in the future.
Okay.
So meaning that next year, when June compares to June this year, instead of it being a 9% increase, it should be flat.
Okay. Great. So it worked.
Well,
Or it's working.
it's working.
Okay.
It is a thing in progress, right?
Okay.
Supply side has stuff to do with that too. So you want to having an administration set different policies can influence supply. Incentivizing oil production, for example, or refinement, incentivizing refining oil can reduce gas prices, right? So that can be something that the Fed has nothing to do with, but an administration at the political level, fiscal policy can influence that. So you've got different aspects where one's going after demand and the other can go after supply. It's just all on what they do.
Well, it sounds really complicated.
It is.
So where are mortgage rates? You said earlier when we were talking mid fives. Is that where they are right now?
Low fives, mid
Low
fives.
fives.
Yeah.
Okay.
Yep.
And in
Under
June.
under 5.5 generally.
Okay, and in June they got above 6.
Yeah. Briefly. Yeah, the market was it was ugly.
Yeah.
It really was. And it was reacting to that they didn't believe the Fed was doing enough.
Okay, that's really interesting. Do you anticipate, where do you see mortgage rates going when you're looking in the future?
Right now, I see them being fairly flat. I don't think that the market's going to get too far in either direction. There will be the ups and downs, typical, but I think they're going to stay flat. I think we've topped out at this point. There were, in the beginning, when they were talking about, in early June when it hit 6%, they were talking about rates going to 7.
I remember that.
They were absolutely, hey, rates are going to have to hit 7 in order to slow the economy. And I don't think that that's the case anymore. I think that just the most recent increases demonstrates that the economy is going to slow considerably with very little movement. I think, the Fed has said that neutral on their policy, that interest rate's like in the mid 3s for the federal funds rate.
Okay. That's the overnight?
Yeah, okay. That's the overnight rate. So that they think that that's neutral, non-accommodative, not encouraging growth and not, causing a recession. I think it's closer to 2.5, which is right about where they're at. I think we're at a point of neutral.
So what I'm seeing in the market right now is that home prices are still maybe a little bit higher than they were, but nothing like February or March where they were quite a lot higher. Is that what you're seeing too? Right,
yeah. I think appreciation is going to slow. That it may even just be flat for a little while. I don't think we're going to see any kind of a crash or anything like that. That's not what we're expecting, and the reason being primarily because supply and demand still are not in balance.
Right, there's not enough homes for the people.
There's just not enough homes for the formation of households, right? So every year we have a certain number of households that get formed, and these are people who have to rent, they have to buy, they have to find housing. That formation is outpacing the inventory, and it continues to do so.
And it's not, that brings up like the supply issue, and that there needs to be, before it changes markets, because we're still in a seller's market because there's still, technically, because there's still not enough homes available. Right.
But it's better now than it was for buyers. They're not going to have to go up against 30 offers. They can be maybe even the only offer and more readily be accepted.
Right. Okay. So the demand has changed. The interest rates are kind of leveling out. There's more inventory. It sounds like it's a great time to buy a home.
It is.
We can help you with that. Hey, Brent, this was a great conversation. Thanks so much.
Yeah, my pleasure.
Okay,
Thank you.
Great. Thank you. If you have any questions for us, let us know. We'd be happy to help you. Thanks.